Good morning, good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. Excited to be here as always. Let's do it.
Absolutely. So I want to talk about the Fed. Mary Daly on Friday came out. We had Mester or Hacker come out on Thursday. Somebody's a hawk, somebody's a dove. All of these things. I actually just want to have a very honest conversation about be careful what you wish for. I think the stock market for the long time has been begging for a cut. I think the stock market then said, okay, I just want to pause. And now the market has talked themselves into all I want them is to do is slow down. So I don't think that's a great outcome. I think the Fed slowing down is actually probably more painful, but damn it, the stock market wants something.
Oh yeah, we're getting a little relief rally right now based on nothing as we have over the last little bit. I mean, I guess earnings, and I will get back to the comment or the question, but earnings have been slightly better than the awful expectations that have been put out there.
The bar was this low and they're getting over it.
Yeah. The hurdle is not very high. But yeah, so they're coming in a little better than what the expectations were that were pretty putrid. But yeah, I think it's interesting to hear kind of you're starting to get one or two Fed governors coming out and having a little bit more of a dovish tone. It's funny. The Fed in general right now seems to be getting really beaten up on a global market basis because everyone around the globe is saying, guys, you are crushing us. You're driving the US dollar through the roof. And this is really bad for our currencies. You know, if you're an emerging market country, you have to pay your debt in US dollars. And we're exporting stuff, and it makes it a lot more expensive for those countries to then buy. Yeah, it's an interesting little quandary that the Fed is finding themselves in. And I don't think we've had as much conversation around global effects out of the Fed as we're having right now.
Very interesting you bring that up, and I'll call it scuttlebutt. How about that?
Scuttlebutt? That's what I was going for. Scutter? What?
Where'd that come from? That's all right. It's early. It's early. It's not as early on the East Coast, but
I was going to say it's not early at all. I just had lunch.
But yeah, it's funny because for the longest time, the Fed, right? My econ degree, my advanced degree in business, it's all been about stable prices and full employment.
Yep.
I think your last comment is there's an untold third truth or third rule or whatever, and that is maintain global interdependency, right? Because the Fed, the US dollar is the reserve currency, and with that comes responsibility. And you're right. I mean, you saw what happened in the UK, kind of UK induced, but you saw capital flee. You have what's going on in Japan, likely intervention. You have emerging markets who are in true pain. So you're right. I think one of the things that's going on today is the Fed is hearing from rest of world and realizing that, yes, inflation is a problem, but so is keeping the world working, the financial market working. So they may slow down. But again, I want to tell the stock market, be careful what you wish for, because that may not be the best outcome for you, Mr. Stock Market.
Right. And it's funny when you see people that might not have much of an education still opining on, U.S. debt level is going to drive the U.S. dollar to no longer be the foreign reserve currency. And you're like, hold on, guys, the U.S. dollar versus a basket of global currencies is up almost 20% for the year. Yeah. This has done nothing but strengthen the US dollar. And so it's laughable to see that stuff. But yeah, it'll be interesting to see how this plays out. I mean, again, we talked about this, several times in the past, but if they don't raise fast enough to control inflation, you can run into that 70s scenario where you start, stop. There was 3 Fed chairmen in the 70s. They stopped thinking they were controlling inflation, and then it got away. And then the next guy stepped in, started, and stopped too quick. And then Volcker came in and yanked the brakes on and obviously forced us into recession. But Fed funds rate by the end of that time frame was at 19%. 19. We're at 3.5 right now. Fed funds rate got to 19% in order to control inflation. Now, inflation was a more pervasive problem then than it is now. Inflation got in double digits. Now it's, we think that we've seen the peak and it's starting to roll over, but still you don't want that situation that you're describing there where we can't actually get control of inflation, let it go, and then it gets ahead of us again.
Yeah. And when I really think about this, right, heading into last week, I was again, the beauty of being an outside person, you don't you don't have responsibility for anything else, right?
Right.
My thought was, hey, Fed's got at least 3 more rate increase in it, 75, 75, 25, 50, whatever it is. And then we can plateau. If what I'm kind of reading between the lines with Mary Daly is, wow, the rest of the world's breaking. We have to raise, because again, Mary's not saying we're not going to get to 5% terminal. She's not asking
Right.
us to lower the terminal rate.
Right.
She's just saying we're going to get there slower. So instead of being done in February, they might be done in July. And
Yep.
what I want to tell the stock market, if that's true, the extended of this pain, or the duration, is going to be much longer.
Yeah, we've been saying, and you've been saying more pronounced than I have, like, at least just get it done. Rip the Band-Aid. Let's get over it. Because again, as we trot along sideways here, it's difficult. And you can kind of foresee that kind of early 2000s type scenario playing out, where you have this just bumping along of the bottom of the stock market for even more than a year, right? I mean, 2000, 2001, 2002, the market did essentially nothing. And it's funny, like, you know, we could do it. I don't know that we're talking about GDP, but GDP is going to get printed here later on this week.
Yeah,
And
Friday.
GDP,
What do you got? I got a positive number.
it's got to be positive. I mean, just because all of the data shows so much, but it's funny. Like, I still think that we're in the midst of a recession. 2001 had a positive GDP print, and that was in an absolute no argument recession in 2001. And there was a positive GDP print then too. So it's weird how things kind of get moved around. GDP is a little bit more wonky and a little bit more volatile than what you would expect it to be. But yeah, nonetheless, I think that we're absolutely in a recession right now. But I do think, just because the numbers have shown up so strong on the positive side, the GDP now, I was looking at it, is positive like 2.8% as of right now. So that's huge.
Yeah, GDP now got a lot of press last in Q2 because it was showing negative, when a lot of people are
Right.
like, oh, it'll be slightly positive. Now that it's clearly positive, a lot of people are poo-pooing it. I'm like, you guys can't have it both ways.
Right.
Either
Right.
it's a
Right.
good
Right.
way, either it's good or bad. You guys just have it when it gives you what you want to hear.
You remember what happened though when you look back at GDP? GDP in Q1 was negative, and it was like, whoa, weird import export issue that drove it to be negative. Okay, let's discount that one. And the second one came through in Q2. We were like, ooh, now that's, you know, some solidification of those negative numbers. And then again, it does look like this one will likely be positive. It would be a big surprise if it came through negative, which I don't think the number is too far positive to see it move that much.
Yeah, because again, if you don't know what GDP now is, or the Fed or the Atlanta Fed tracker, it updates every day. Right.
Yep.
It's taking
Yep.
in current information and the closer you get to the date, which is Friday, the better it gets. That's just how it works.
Yep. And granted, you can manipulate quantitative numbers, just numbers based, but there's no qualitative. So there's no one in there going, hey, let's throw this one at, or, you know, now granted, what they put in could, you know, it always stays the same, but you could argue it's weird stuff that goes in, but the data is what the data is, and it spits out a result. So there's no one in there, you know, tooling around with it.
There's nobody mucking. There's no political narrative in the numbers.
Correct.
It's just
Correct.
raw data, which is really interesting. If it does come out at 2 point whatever, it will actually make the year positive.
Yeah. Yeah. It'll be interesting.
Isn't that wild?
It's funny, the rate of change. I mean, outside of GDP, you look at earnings reports, you look at all other economic barometers, the rate of change is slowing. And so I think it's hard to argue that. But to your point, if it comes out positive, you will see, you know, as of this point, this year will be certainly positive.
Yeah, it's pretty wild to think about. So very, very cool. You know what? So again, I just want to go back to kind of point of number one. And you got 10 years on the street, or Wall Street. So I don't think, and again, maybe it's individual traders, maybe it's retail, but the Fed slowing down, right? I kind of think of it like climbing a mountain. You either can take the fast route or you can take the long scenic route. You both get to the end point eventually. I personally want to get there faster. Maybe what the Fed is telling us is we want to go faster, but we simply can't. But what I think I think Wall Street's wrong again. It's, guys, you want them to be done. You want the Fed to pause. You don't want the Fed to slow down. Slowing down doesn't help you, does it?
Right. I no, but I do think, kind of back to the conversation on the global front, like the Japanese yen is to 145 right now. That is like a massive move and a strengthening of the dollar. And Japan is now coming in with their foreign reserves, US dollars, and beneath the surface buying yen to try to pin down and try to get it to be more competitive. So I think the knockover effect into other economies, other just global economics in general could be meaningful if it gets ripped too quickly. And I think that's
I agree.
probably the real fear there. So I don't necessarily blame them if they were to take a little bit more of a drawn out approach. Again, if it was just us in a vacuum, I'm totally with you. Rip the Band-Aid. Our economy is fine-ish, call it. There's no
Yeah.
huge black eye that people don't already see. It's slowing down. We get it. But
Mhm.
rip the Band-Aid off. It would be better for all of us, be better for the stock market. We gap downwards, and then we can form that bottom and come out
Yeah.
of the other side and start
Mhm.
to get some optimism back in the market. But I think the problem is more of that global effect that we have right now as the world
Yeah,
dominated currency.
I
And it
agree.
could just really have ripple over effects into the UK, who's struggling, into the Eurozone in general. It's struggling. The yen is clearly struggling. China is now elected the regime to be there for another 5 years that has no capitalistic view at all.
No.
So,
You see their market get whacked, or Hong Kong get whacked, their
oh,
tech
down
stocks
six
down
and a
like
half
50.
percent overnight.
Yeah,
Yeah.
that's not a sign of strength. That's
No,
not good.
no, it's
I'm
not.
just saying.
Nor is going back to them not reporting their GDP a week ago or whatever it was.
Yeah. Oh, yeah. Yeah. Oh, by the way, surprise to the upside. Yeah, I bet it did.
Yeah, exactly.
Oh man. So Taylor, you put out a lot of stuff on Instagram that people that really help them understand what's going on. What is it? Where can people find you?
Yeah, find us at Life Goal Investments. That's our Instagram, at Life Goal Investments. I appreciate you.
Of course. Thanks, buddy.